is the notion about explaining the club, the business of your club, the business of clubs to your board. There's, as we all know, we're not going to go into the challenges, governance of the industry. We understand the governance model of the industry and the challenges, and I've actually changed my view of my perspective on that challenge over the last, I would say, 6 to 12 months. And a couple things have become clear that I think the industry hasn't maybe done a great job of over the last, I guess you could say, 100 years. Finance, the language of business is finance. When you go around the world and people describe businesses, or analysts describe businesses, or CEOs talk to their businesses about each other, the language of finance, not accounting, but finance, and we'll talk a little bit about the difference, but is intertwined in that discussion. When you don't have the language of finance in play in describing your business, you end up sort of telling stories about the business, or using anecdotes, or using examples. And when we sort of continuously learn about what it is we're actually doing in the industry, and what we're actually doing is trying to embed the language of finance into the club business. So that's one theme, is that you have to explain a business through the language of finance. And the other theme of this session is something that's really hit me over the head even more recently, and that's in the last couple years. We do an awful lot for our members. We do, mostly my partner Ray, who most of you probably know, does a lot of board presentations for our members. GMs have him come in and say, hey, help us kickstart this, help me, either it's an orientation or just try to, wrangle the board in the right direction. Help us explain the language of our club using finance to the board. And it occurred to me about a month ago that we bat 1,000 effectively in the hundreds of well over 100 instances that we've been in front of boards, explaining the club in the language that, frankly, most board members understand, which is finance. They're used to ratios, they're used to margins, they're used to pie charts. If they're business folks, they're not always all business folks, but a lot of them are business folks. They're used to that language of finance. That's a language they understand. And I think one of the gaps that's been missing in this industry is that the industry tends to describe itself using stories, and the board members tend to understand a different language, which is finance. And so it occurred to me that in really 100% of those board interactions, we get feedback like, I've been a member at this club for 30 years, and I now have a completely different view of the club than I've ever had before. I understand it differently. Now I know what drives it. And so it occurred to me that really we can't necessarily fret over the governance model that we have in the industry. It's challenging, I get it. But we have to say, well, given that, it's our obligation. I mean controllers, GMs, what we do. I think it's really ultimately our obligation to speak to them in a language that they do understand. Frankly, I wouldn't just say it's our obligation. It might also be a mode of self-preservation, because when we don't speak to them in that language, it leaves lots open for interpretation, and that goes down a very bad path quite often. So in this notion of it's not a story, it's a number. I'm not saying that there aren't stories and around service and quality and things like that, but the financial language of clubs, it's not a story, it's a number. We're going to go through some examples of that. We're not going to go through deep dive into all the numbers that we normally do, but we're going to use some examples. And in order to understand a business, as I think most board folks would get, you have to talk about things like revenue, gross profits and gross margins, fixed expenses, operating results, capital needs and sources. The key ratios that are the drivers of the business. It's just like if you're in the boardroom of Apple, you're not talking about the cost of individual components, right? You're talking about the gross margin of the iPhone, and it's going from 62 to 63 or 62 to 61, and what does that mean to the bottom line of the club, of the business? They're talking at that level, and I think board members understand that, and I think it's our obligation to start discussing the industry using that language. So that's what we're going to talk about. And in that, as we get smarter about this and we sort of understand, because what we do is we start with data, and then we move that data through a pipeline, and we ultimately try to figure out, and gain insight at the end. And we saw a little video the other day that put into words very succinctly what we do and how we try to convey what we collect versus what we discuss back to the industry and back to boards and GMs. But data is that list of raw facts and figures. We're going to have some examples, but you all know, could come up with a very easy example. Hey, go find out what the 10 clubs around us charges for dues, right? And you come back with a list of numbers. That's data. It's just raw facts and figures. There's no context to it. The examples I give, I'm going to try to say, how does the industry behave in terms of data? What does it mean to apply context to that data? So now you have information, not just data. And then how do you turn that into knowledge, which is really the information that you've created plus adding additional insight on top of that. And it's the knowledge where the rubber really hits the road, and frankly I think where boards, GMs, industry, clubs ultimately prevail is when we all have shared knowledge, not just shared data, right? There's lots of data running around the industry. It's not about data, it's about knowledge. And by the way, I kind of like the subtractive line I have here, opinion, of which there's also a lot of, is that it's the insight, it's the attempt at insight, but it's lacking the information of knowledge. So it's people with opinions often think that they have insight, but in fact what they're really doing is lacking the information or knowledge. So, the significant problems in the industry we're going to talk about today in the way that we think the language of finance and how do you explain your club to the board. It's about applying that information and knowledge, and it's about moving beyond the opinion, and it's filling it with financial information, not accounting, not 30 pages of financial data that frankly many clubs bring into the boardroom every month. You could go around and swat flies with these 30, 40, 50, 60 page monthly packs. Quite often the strategy behind that is throw so much at them that they don't look at any of it because there's so much there, right? That's not really the end game that we want to get to. The more effective thing would be, what would be the one page of the one piece of paper that would in fact convey knowledge? And the industry hasn't been able to do that very effectively, so we throw so much data at them that we try to sort of get through the knothole of that meeting by having so much thrown at them. We got to get through that. It puts clubs at risk. It puts GMs at risk. It puts the whole industry at risk. Going back to finance is the language of business. If you asked, I'm sure many of you have board members that either are executive levels of businesses or have their own businesses. If you ask them, one of the key metrics of any business, do you know what your gross margin is? We actually play this game when we do boardroom presentations quite often. We'll find out who in the room there's usually a few board owner or business owners, and we'll ask them, in the context of the discussion, do you know the gross margin of your business? And quite often with pride, they say, of course I do. It's 37.8, or it's 62, or 61, or 78.2. They know it to the number and often to the decimal point. And we ask them, well, why do you know that? Well, because I know as my gross margin goes, so goes the operating result of my business. And so they understand the correlation between that key performance indicator and the results of their business. Same thing with, if you ask them their fixed expenses, if you ask them their net operating margin, right, the bottom line margin, they know all those things. It's the language they understand. In that game we play, of course, we always say, do any of you know the gross margin of your club? And not a single hand has yet gone up in the well over 100 board meetings we've ever done, because they've never thought, the business has never been described to them that way, and thus they've never thought of their business that way. So there's a huge gap and a huge opportunity. I truly believe, this isn't just spin, I truly believe that if you could snap your fingers in every club in the country, describe their club to their board using the language of finance, not just describe, explain using the language of finance, it would change the industry and would change 50% of the clubs almost overnight in terms of the dialogue that's had and the strategic direction that results. I'm just going to take a second here. This is all about financial modeling, and to give you an example, we were sitting on a plane the other day. We were on planes constantly. And we said, let's come up with an example that people might be able to grasp easier before we jump into the club side of this. And we said, hey, we're on planes all the time. Let's look at 3 different airlines. And let's just take a quick look, not deep dive financial modeling like a Wall Street analyst would do, but let's just look at things like revenue and cost of goods and the gross profit and gross margin and operating expenses. Very high level, brief sort of income statement, if you will. And let's look at 3 different airlines, American, United, and Southwest. That industry has been collapsing, so there aren't as many as there used to be, and we just picked these 3. And so, the individual numbers don't matter, but what we do is, in any time you're analyzing an industry, you look for sort of patterns. Who follows directly down the middle, who looks different, and why do they look different? That's the whole notion of financial modeling. And so, a couple of things jump out very quickly, and you look at, American and United, and they've got, $40 million in revenue and gross margins of about 30%. And then you notice Southwest is about half their size, and they've got a gross margin of about 70%. Obviously, more margin means you have more money to apply towards fixed expenses, and so we just took this as an example. We said, well, what's going on here? How does looking at the numbers, explaining these business through the language of finance help describe the business, much like we could do in a club. And lo and behold, when you dig into it, you find out, well, in fact, Southwest has a little bit of a different operational model that results in a different financial model. So their planes fly on average about 9 hours a day versus 7 hours for the other carriers. They pay their pilots less. Interestingly, maybe it's part of their culture, kind of a fun culture, and they're able to get away with paying them less, although there is some battle around that. They are much more effective at hedging fuel prices, and a huge thing is that they only maintain one type of aircraft. So the whole soup to nuts of training, parts, maintenance, all those things, by having one aircraft is drastically different. And so because they have higher gross margins, that means they can spend more on the fixed operating expense side of the business, and that's why every 10th ad on TV is a Southwest ad, and it's not an American or a United ad, because the gross margins of American and United don't allow for that. The gross margin of Southwest does. So this is just an easy example of how even rudimentary financial modeling can help you explain both the industry and a particular business within that industry. Okay, so that was just a little bit of a warm-up around the notion of financial modeling. And Wall Street spends billions across the analyst world on paying people to analyze industries and to analyze companies within the different industries. And interestingly, when they hire analysts, they don't say, okay, you're a new analyst, we want you to analyze Microsoft, General Motors, Pulte Homes, and I don't know, some other company in some different industry, right? They don't say that. They say, you're the banking analyst, you're the home building analyst, you're the real estate analyst, whatever it might be, because they understand, in order to understand any one particular company, you have to understand the whole industry of companies. And that's the same thing in the club world. In order to understand a particular club, you have to understand the industry. We're going to talk about more, and that's part of explaining the business. But you have to model the relationships between revenue, margins, debt, expenses, the bottom line. And so it's really the key drivers that we think we've developed a set of key drivers, and that may be the only set, but we think they're an effective set that can be used to explain the business, right? This is all, again, the theme of how do we explain the business to the board, as opposed to leaving a vacuum and letting the board try to explain the business to us, right? We've all tried that for the last 50 years, and we know how it works, right? If you've been on We're on the vendor side of that, and we come in to try to help that. But in the GM world, when you're on the receiving side of that, of the board trying to explain to you how clubs work, that's a pretty rough place to be. It's a place that anyone with a career more than 10 years or 15 years has probably experienced that, and it's fraught with danger and frustration, and frankly, it's not good for the club either. So it's really about explaining the club using the key drivers, not data, not even information, but insight, and we'll talk about that in a second. Just another quick example. I use the airline industry as an example. We did look at some data across that, but the insight, cholesterol is a great example. You could say, if a doctor tells you, hey, your cholesterol's 200, and well, what does that mean? Do we know what is 200, high, low? And if you were his only patient, the answer would be, I have no idea. I just know what yours is, and by the way, maybe I test it different than everybody else does. You have to have standardization around what you measure, how you measure, and then you have to study the variation. So in fact, we know, when you study the variation, we know that, hey, there are ratios of HDL to LDL. There are ratios of total cholesterol to HDL, and it's the study of variation that gives you that link to health or towards coronary artery disease. That's the insight. And so when you either only look at your own club or you only look at data and you don't study the insight and the variation, you're not able to come up with the direction and the explanations that are meaningful to have the meaningful dialogues in the boardroom. So to move ahead before we get into the data, would you want a doctor whose knowledge is based on the study of a single patient? Of course not. What information does your board generally see? It sees the information of that club. So how are they possibly able to make judgments and distinctions around good direction, bad direction, enough dues, not enough dues, too much spending, not enough spending, too much labor, not enough labor, whatever it might be, if the only thing they see is their own club? It's not possible, because you can't, just as a Wall Street analyst can't understand a particular company without understanding how that company behaves within the industry. You can't understand a club if you don't understand how the club behaves within the industry. So the phrase I like, it's kind of a pithy short phrase, but you can't understand a club without studying the industry, and you can't understand the industry by studying one club. I truly believe that, and I think that's kind of the linchpin of where we are in the industry and what we do, and I think how we've helped a lot of folks. But so we've developed models, and we're going to use some examples around maybe the way that people used to describe their club or explain their club, and how you would explain your club using first information, moving from data to information to insight. I'm going to skip through this chart because we've sort of already talked about this, but the biggest issue in the boardroom, as we see it, one of the biggest, I'll say, is that lack of context. There's lots of data, there's very little context, and I would say there's even less information and insight, and that generates lots of discussions that shouldn't be had. Frankly, the food and beverage trap falls into that category quite a bit, and it avoids the discussions that should be had, like how much dues revenue does this club need to support our operations? What are our capital needs and capital resources over the next 5 years, and are those things aligned or greatly misaligned? I'm sure if you put a stopwatch on, how often are those last two questions, which are strategic, are discussed versus how often cost of food is discussed? I think in most cases we know which side that would fall on, and it's not the favorable side. So how do we explain? Here's a few examples. Right? How do we explain the business to the board? Can a board be effective without actually understanding the business? And I don't mean them thinking they understand the business, but I mean them actually understanding the business. Right? How do they get through that knothole? Just like cholesterol is bad isn't an explanation, right? Well, cholesterol of 250 or more and HDL to LDL of this and this, that's an explanation. Cholesterol is bad, not an explanation. Clubs are in the dues business is not an explanation. It just no more is that an explanation than in the case of airlines. Airlines are in the business of moving people from point A to point B. It's true but it's not an explanation of the business. And if we're trying to discuss the business in the language that boards understand, we have to get beyond the story, right? This is a story, and into the language of finance that they understand. And so, you know, a very common occurrence would be for a board to say, hey, go call 20 clubs and find out what their dues is. And then come up with a list of 20 sets of what they charge for a full member per year. And it's, you know, 10,000, 6,000, 8,000, 15,000. And you have a big long column, and you get to the end of the column, and you do an average, and the average is 7,200. And you say, well, okay, we're charging 10,000. I don't know. I guess we're too high, right? Yeah, I mean, this actually happens. Or we charge 5,000. Oh, we're low. We should raise it. They take data and they try to infer insight from the data, and you can't because there's no context to it. So let's move through the curve, right? So what we do is, frankly, we collect that list of data, right? We collect all those sets of dues, but then we do something to it to apply context. We say, again, the notion of how do you explain the business, right? We say, well, let's look at how much of a club's revenue actually comes from dues. We call it the dues ratio. It comes to at the median about 50%. So now, in terms of explaining the business, when a board member says, go collect a bunch of dues, an explanation might be, well, in this industry, clubs have dues revenue that at the median equates to about 50% of their revenue. So now we've put some context to it, right? How much of my revenue comes from dues? Boy, that's a lot more information than how much an individual member pays to be a member at the club. How much of a club's revenue comes from dues? That's pretty good information, and we can see there's a wide curve. So that's information. Now we apply insight on top of that, right? We take that knowledge and we say, let's look for some things we can sort of tie to that. Well, wait a minute. Now we see that if a club has a dues ratio in the low 40s, it has a gross margin significantly lower than the middle of the industry. If a club has a dues ratio of greater than 55%, it has a gross margin significantly higher than the median of the industry. This is now insight, right? And by the way, operating loss goes the same way, not surprisingly. Boards will understand how much of it's like the razor and the blade thing, right? Dues is the high margin revenue. How much of my revenue comes from dues? That connects to gross margin, and gross margin connects to operating result. This is a language that boards will understand, and now if the board starts asking the question, how much of our revenue comes from dues? By the way, how much dues revenue do we need? Not how much a member pays, but how much dues revenue does this club need? Now they're starting to understand the business, because the question now you get into the notion of, okay, if we sort of understand how much dues revenue we need to run, well, there's only two things we can adjust: how many members we have and how much it costs to be a member. And you start to realize that the question of how much do other members at other clubs pay for dues has absolutely nothing to do with the explanation of how dues impacts the bottom line operating result of our club. That's one example of explaining the business, right? Explain the business. What's the key ratio that matters? How do you affect that ratio? And what are the things that ratio affects? Board members understand that language. This is finance. It's not accounting. And we've seen it. They resonate with that type of language. By the way, if you were to explain the business a little further, you'd say, by the way, board member, in clubs with golf, the median dues ratio is at 50%. In clubs without golf, the median dues ratio is about 10 points lower. The reason that is because a higher percentage of their revenue comes from food and beverage, and therefore a lower amount comes from dues. That explains the business, right? Not I don't want to have a dues increase. That's a story, right? The president comes in, under my watch, we'll never have a dues increase. That's a story that's disconnected from the explanation of the business. Explanation of the business around dues is what we just went through. Let's go to the next example around how the language of finance needs to be used to explain the business. Let's talk about food and beverage quickly, right? What are the things the board members say? We need to make money in F&B. Why don't we make money like a restaurant? Go find out how much other clubs make in food and beverage, because they've always got the assumption that their club is the only one that loses money and all the other clubs make money. Meanwhile, we're trying to say, well, F&B is an amenity, and we fell to that trap. It's true in the industry. We know it's true. We have the data that says it's true, but it's not an explanation. We have to explain it in the language of finance that they understand. And so here's an example. This actually happened. This is a list of 30 clubs. This is the data is raw facts and figures thing. Club went out, said find 30 other clubs in our area and find out what their net result is, their bottom line is in food and beverage. And we've all done this, right? You come up with a column of numbers. It ranged from a loss of $563,000 to a profit of $334,000. Now, what's the natural thing? If you give this list of data to a board member, what are they going to say? What do we have to do to be one of these clubs down here? Why can't we make $200,000 in food and beverage? Okay? Tuck that away. We're going to come back to it in a second. The way you can explain, how do we explain the industry, the industry relative to food and beverage? How do I explain it when I have 30 seconds to explain it to a board member, or a minute if I run into a board member somewhere? I say, well, in the industry, here's the zero line, 3/4 of the clubs lose money in food and beverage. The way we apply context to it, not insight yet, but context, is we say you can't look at an absolute number of loss or gain in food and beverage because, hey, that might be a $1 million club, it might be a $30 million club. We say, how does that result in food and beverage correlate to the gross profit of the club, right? The gross profit is what you fund all your operating expenses, just like you would have in any business. Board members understand. Gross profit, fund operating expenses. So we say, how much of that, how much to put it in context? Well, I lose $200,000. Well, that's 4% of our gross profit. Bang, we're right smack in the middle. And if you didn't have insight yet, you might still even look at this chart, and this happens. We kind of play this game. We say, well, where would you rather be on this chart? Would you rather be Group A, where there's a deep subsidy? We could call it a loss, but relatively, they have a relatively large subsidy into food and beverage, or Group C, where they actually make money in food and beverage. They're above the break-even line. And of course, if you ask most board members, oh man, we want to be up here. There's 25% of the industry that's hitting it out of the park. We want to be one of these guys. So now we've got both data and we've got some context, but we don't have insight yet. When we start to apply insight, we say, well, let's actually look at the clubs in Group A and look at the clubs in Group C. The clubs in Group C, wow, their dues ratio is significantly low. They're 44%. Their F&B, since we're talking about F&B, labor ratio is at 54%. Their median initiation fee is $14,000. Wait a minute. The clubs in Group A, right, these are the ones that we thought were the dogs, the ones that are, quote, losing the most money in F&B. We don't want to be them, right, board members thinking. We want to be these guys. Let's look at those clubs. Their dues ratio is 12 points higher. So if you're a $6 million club, 12 points is what? $720,000 more of dues revenue, right? That's the good revenue. That's dollar for dollar margin. $720,000 more in a $6 million club than this club has. What does that allow them to do? Look at their F&B labor ratio. They're throwing 82 cents of every F&B dollar at service. Are they a high expectation, high service club? Let's look at their initiation fee. $52,000 at the median versus $14,000. So the data would say, boy, I want to be one of these clubs, not one of these clubs. The context says, well, let's look at the size of that subsidy or gain relative to the gross profit of the club. And the insight says, wait a minute, I get it. These are the financially healthy clubs. They're actually intentionally throwing money into food and beverage as a subsidy because they recognize that the marketplace sees that as a value, clearly, because the marketplace has spoken and said, we're willing to spend 50 grand to join this club and only 14 grand to join this club. So now there's a different, now if you ask a board member, you show them these two charts, which club would you, this chart, which club would you rather be? The answer you generally get is, I want to be Club A, or Group A, right? It's a completely different answer that you get through insight than you got through data alone. And that, again, it's using finance to explain the club, but then bring insight in. By the way, just to give you a specific, of these specific clubs, we took the top club and the bottom club, right? The one that, quote, lost the most in food and beverage. Of this is just a small data set. And the one that had a pretty significant profit, right? They made 300 grand out of food and beverage. The club that had a $500,000 loss has an initiation fee of $37,000. The club that made a whole bunch of money, initiation fee of $1,000. Dues revenue, $2.4 million, $720,000. A net available capital ratio, which is the governing number that says, can this club afford to reinvest back in itself? 22%, 5%. Turnover ratio, 5%, 20%. So by looking at the column of data, and without insight, you come to one conclusion. By applying insight, you come to the exact opposite conclusion. There's no question in anybody's mind listening to this that all day long you want to be this club and not this club, because in fact this club is a club that may not be here a year or two from now. And it's critical to apply not only the language of finance, but to put that layer of information and knowledge on top of the data. Data is very, very dangerous, and this industry has been, has not generally done a pretty good job of that. I hope that's telling, and I hope that's a good example. One more example about how do we explain the business to our boards. It's crucial. Boards need to have the business explained to them, and you have a very, very short period of time to do it because they're on and off the board so quickly. If you burn a year and the business hasn't been explained to that board member, you've almost lost the cycle because, depending on their term and how it goes, if it's 3 years, you might still be able to get them. If you've blown through 2 years, they're on their way out. Things like, board member says, we have too much labor. There's people all over the place. We have too many people. By just saying we don't have too many people, that's not an explanation. What actually happens? I mean, this happens. This happens to us all the time. We get phone calls. What's the data? What happens? Hey, go call 10 other clubs, 20 other clubs, find out how much they pay the GM, how much they pay the superintendent, how much they pay the chef, how much they pay their servers, how much they pay their course maintenance staff. Come back with that list of salary and wages, and then we'll figure out what our salary and wages should be relative to everybody else. That's a list of data. There's no context of that, and there is, in fact, no way to have the discussion around do we have too much or too little labor without applying context to it using financial management, which is a financial ratio. The financial ratio we use. So how do I explain payroll and labor to someone who doesn't understand the industry yet? I say, well, at the meeting of the industry, clubs spend about 55% of their revenue on payroll, and payroll correlates directly to the operating bottom line of the club. Now, it also correlates to member satisfaction, so there is a tension of opposites here. But from a pure math perspective, the way I explain it, median club has 55% payroll ratio. When you get above 60%, it's very, very hard to break even, and those clubs generally burn cash operationally. When you get below 50%, clubs often generate significant operating profits, but these also tend to be the for-profit clubs or the clubs that have, drilled down so tightly on labor that there can be an impact on member satisfaction. So there's that tension of opposites there. But that's the way you explain the business. So now, if a board member says we have too much labor, well, let's look. Are we at 52%? Are we at 58%? Are we at 65%? If you have that financial management ratio, you can now have a discussion, and you can say, wow, I see we're at 62%. We are, in fact, high. No wonder we're burning cash operationally. We have to have a strategic move over the next couple of years to move this down the curve, and we're going to impact the bottom line of the club. That's the insight, the correlation of the ratio to the bottom line of the club. The corollary can be, wow, we're down at 50%, 49%. You know, no wonder it takes me 10 minutes to get a drink around here. No wonder it feels like, you know, the service is poor. You know, we are underfunding payroll. Now, the question becomes, can we afford to add payroll? And then you get into the other things like the dues ratio. But that's the whole point of explaining the business using finance so that a board member, you know, this is kind of nirvana. I picture it. And you picture the set of these dozen ratios that a board member looks at and understands the correlation between those things and says, well, in order, you know, we haven't wanted to raise dues in the last 5 years. In order to survive, we've had to squeeze down payroll and get rid of people because we haven't raised dues. Oh, now I get it. If we want to have a rational level of service that the industry seems to operate around, to afford that, we have to have a higher dues ratio, right? The reason we have a 50% payroll ratio is because we have a 42% dues ratio. In order to impact the payroll ratio, we have to impact the dues ratio so we can afford to move up the member service line, right? The service expectation line. Guess what? We're going to invoke the best practice of doing a dues increase every single year, you know, 2.5%, whatever it is. Doesn't happen overnight, but you have to start somewhere by explaining the business using the language of finance. I know I'm hitting a broken record, but I really do believe that it's not the board member's obligation to come into the boardroom initially understanding the business of clubs. They can't. They've been in other industries. They can't possibly come into the room, come join the board knowing that. It's our obligation to explain it to them, and we have to explain it to them in the language they understand, which is finance and financial ratios. So, you know, this is about explaining the business. I hope those examples were relatively good. I hope they were effective at defining the difference between data, context, and insight. And you kind of need to move down that chain. If you're stuck in the world of simply collecting data and giving data to the board, frankly, you're giving a loaded gun to a 5-year-old. They're smart people. I'm not saying they're not. They have the intelligence of 5-year-olds. Boards generally want to do the right thing, and they are smart people. But we have to. It's our obligation to give them the right tools. In this case, the right tool is the language of finance, number one, and it's the context of how does our club operate and how does the industry operate, right? You can't understand the industry. You can't understand your club without understanding the industry. You can't understand the industry by only understanding one club. And to the folks, I know there's a lot of folks on the call that are club benchmarking subscribers. That's the whole idea, right? That's what we try to help you do. That's what we have access to. If you're not, we have a ton of resources on our website that are free, videos, webinars, things like this that we've recorded, blogs that you're free to tap into and use all you want. If you end up joining, that's great. But if not, there's a lot of great information there I encourage you to use. So the final step here in explaining the business, and this is I went down a little bit into the examples. Now I'm coming back up. Right, putting a chart like this in front of a board so they get, this is like any other business. Just because you're in the club business does not make you immune to the laws of finance and the laws of financial management. And so, we've got revenue, we've got cost of revenue, we've got gross profit. That gross profit goes to fund our fixed operating expenses, and that generates an operating result. That is no different than any of the businesses that your board members are part of. And they will get this entirely. It's not pictures, what comes out of the platform, or pictures and charts. The difference here is we've got an operating result which either subtracts from or adds to the capital side of the business, and ultimately it is the capital side of the business which dictates is the club moving down a value creation path or a cost reduction path. So, there's too much of a vacuum in the boardroom, and it's our obligation, all of us on this call, to fill that vacuum, not to react to the void, but to eliminate the void. And elimination of the void can only come from explaining the business using numbers, not stories. This stuff is mission critical. When you leave the vacuum in place, we've all been around the industry long enough. I've only been in the industry 8 years, and I've seen already hundreds of examples. When you leave the vacuum in place, bad things happen, right? Things go wildly off track, not because of poor intent, but just because of lack of information, lack of explanation, lack of knowledge. They might have data, but they don't have knowledge. So, we go through, there's a lot of executive dashboard discussions we've done. We've come up with about 14 key performance indicators which we believe completely explain the business. If you're already a member and not using these dashboard financial management, not accounting, but financial management metrics, I encourage you to go ahead and do that, because they are the first step in applying context to data, right? The insight, frankly, sometimes we have to help with, to be totally honest. I mean, our charts that come out of the system give you great context. I think it's through working with us directly and through using a lot of the materials we have on the website that you're able to, and webinars like this, that you're able to apply the insight on top of it. As we evolve, we have to get better. Our obligation is to get better in not just conveying the context, which we do very well, but automatically out of the platform conveying the insight, right? Connecting those dots, and sometimes we have to do the overlays you saw today to help connect those dots for you. But if you're working in data only and no context, it's very bad place to be, right? Go find how much the dues are, go find what the food and beverage loss is, go find how much they spend on their course, right? All that stuff is not only a waste of time, but it's actually dangerous. So, this is just the executive dashboard that we look at. We look at finance, capital, operations, membership, and debt. It's very strategic, and when we start working with clubs, it's the very first report we run, and it's it's frankly, at the board level, it's probably the only report that they even need. Committees might get into some of the lower reports, but it moves them up a level to the key drivers, which is the whole key. For the sake of time, I do want to leave a little bit of time to see if there are any questions. But the FNB Trap, we've already talked about FNB, but that frankly is proof that the industry does have a gap of both context and knowledge, and that it needs that framework. Everybody on this call understands that whether your cost of food is 39% or 44%, that's not going to change the long-term financial results of the club, and it's a waste of time to spend time talking about, but it happens all the time. So, that discussion happens every day or every month in boardrooms, but we know by the data 50% of the clubs are not generating the capital they need, and they don't even know it. They don't even know to ask the question, let alone even know to have the information, the context, and the view of the industry to know that we're undercapitalized by half or by 50 or 60% or 80% or whatever it might be. We've got the irrigation system we have to replace, and we have no money in the bank, and we've never thought ahead. So instead of getting $50 a month in capital dues from every member for the last 10 years, we've got nothing, and now we have to go find $2 million, which is the equivalent of $20,000 from every member, and we either got to go after them in one chunk or take on debt. It's the slow feed of that versus the big hit all at once. That's just an example, but I think everybody in the call knows exactly what I mean. And again, for the sake of time, this is just another financial management ratio: net available capital, capital rich versus capital starved. You might even, clubs might even ask the question, find out what everybody's initiation fee is, right? Go down, and it might have a little bit of marketing information, but it doesn't provide any insight, because what are you going to do? I mean, if you find half the clubs have an initiation fee lower than ours, are you going to lower your initiation fee to match them? The real answer is you want to have a value proposition that gives you confidence in it. You want to have the highest, my view, you want to have the highest initiation fee of everyone in the area and you want to have a plan and a strategy and a story and amenities that say, yeah, we have an initiation fee. It costs money to keep this place looking really good, and our members fund all that, and we want people coming in with skin in the game and to help fund it. So that you're funding it now, and the next member 2 months from now is going to contribute to the funding, and you don't want to chase that list of initiation fees and say, well, what's the average? Well, let's just do that. You have to develop your own value proposition, and that how that correlates to capital rich versus capital starved is key. So that's data saying what percentage of our revenue ultimately falls to the bottom line so that we can reinvest back in ourselves or pay down debt. That's a financial management ratio that every single boardroom board member in the country should understand, because it explains the business, right? Capital starved. I don't have it on this chart. The insight on what does it mean to be capital starved versus capital rich. It means that you have member turnover, which is 2 and 3 times higher. It means that your net asset value of the club is actually shrinking over time, not growing over time. You're literally depreciating down into like a black hole, right? You picture a black hole collapses on itself. So there's a ton of insight around capital starved versus capital rich that is obviously critical. So I'm gonna end it at that. There are some other numbers and ratios that clearly are important around the notion of capital and explaining capital to the board, explaining the club to the board relative to capital, right? Boards, especially if you've got a C-level public company executives on your board, they get things like return on equity, right? And when you say, what does it mean to be capital starved versus capital rich? Capital starved clubs have a return on equity of 5%. Capital rich clubs have a return on equity of 13%. We'll ignore the math behind it right now. They're going to understand that language 100%. Now, I'm not saying it's easy, for a GM who's been 20 years and hasn't been using this language to just come in one shot and start having an ROE discussion. It's not. But when you understand that a capital starved club, commodity companies, right, iron ore, basic materials, basic industrials, commodity companies literally have a return on equity of 6%. So capital starved clubs literally put themselves in the company of commodity companies. A club which is a commodity, meaning it's competing only on price, is in a very, very dangerous position. Club that's got a high return on equity, this is like what consumer staple companies and utilities, they've got, ROEs around 13%. It's very rational. You create value in the marketplace beyond what a commodity does. And thus, for the members, these companies, these clubs are reinvesting on a frequent basis because they have the capital to reinvest. These are financial discussions. These are the explanation of a club using the language of finance. It's the language that boards understand, and it's the language that, frankly, the industry has to start using. I truly believe that if we can move down the path of explaining clubs using the language that boards understand, not only will the tide float all boats, I actually believe that it will have an impact on the tenure cycle of general managers at clubs, because we know the story of what happens in the industry, and it's because the vacuum exists in the boardroom, and it's filled with it's filled maybe with data and opinion as opposed to information and insight, and we have to apply the financial insight so that they view it as a financial entity. A club is a financial entity, no different than any company, no different than club benchmarking is a financial entity. And we watch the health of our business. Everybody watches the health of their business through finance, and it's no different in the club world. So we're going to end it at that. I hope it was valuable. I want to leave a few minutes here to see if there are any questions. Certainly, feel free to contact me with any questions after the fact. My email is on the screen right now. I think I haven't looked at the attendee list, but I'm guessing I know an awful lot of you. So feel free to call or shoot me an email. And I want to just jump over to Terry, and see if are there any questions that have come in on the chat panes?
Yes. Russ, does club benchmarking have a good database and analysis for bundled golf communities?
Oh, Terry, I have to turn up my speakers. Hang on a second. I had my speakers turned down, and I'm afraid I'm going to have to ask you to repeat what you said.
Okay. The question is, does club benchmarking have a good database and analysis for bundled golf communities, a big concentration in Southwest Florida?
Yeah, no doubt about it. I mean, you look at like the Naples area and things like that, and we do. About 20% of our database are HOAs, and you know, it's interesting. It's the same model. You use the same model, but when we do look at HOAs, we do compare it against other HOAs because, you know, I talked about food and beverage, but you know, there are the HOAs, especially in Florida, tend to have higher subsidies into food and beverage. They tend to be more dues oriented, so they tend to have a little bit higher dues ratio, but of course they spend it. Some of where they spend it is on food and beverage. So not to get into the analysis of it, but yeah, the bottom line is we do have a significant number of bundled communities, and yeah, the data is equally valid for those, and it's equally valid to explain a bundled community as it is a standalone club.
Not seeing any other questions. Again, Russ's email address is on the screen, so if you have something you'd like to talk to us about afterwards, feel free to send an email.
That's great. I appreciate it. I know I went through, I didn't go through all the numbers. I did go through some, and sometimes it's a little fast. But I hope it themes resonate around using finance to explain the club, and the notion around data versus knowledge versus insight. That's the path I believe leads to success for everybody on this call and for clubs in the industry. So with that, thank you very much. I appreciate it, and I hope we'll see you all soon somewhere.